Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the No Trader Show. The S&P is ripping higher today, up about 1.2% as I speak, and now less than 1% from its all-time high. So to discuss this and also find out a lot more about what he does is a very special guest we have this week. His name is Corey Fleck, and Corey is host of the KE Report. KE is Correlon Economic Report. It's a radio show and podcast syndicated across the U.S. Corey's been involved in the financial community for over 10 years as an investor, an advisor, focusing on the resource industry. Since obtaining his CPA in Canada, Corey has consulted with a number of private investor groups, advising these groups in the financial conditions and future of companies in the resource sector. Corey has analyzed thousands of venture and mid-tier companies. As an investor, Corey looks to find fundamentally sound companies in depressed and emerging industries. And it is my honor to have Corey join us today. Corey, thanks for coming.
Hey, thanks for the invite, Rick.
It's always a pleasure to talk to you. Often we have reverse roles. You're the host and I'm on your show. And I thought it would be a really good idea to have our listeners find out more about the KE Report, how it started, where it came from, and how you became so fortunate as to be able to be the host of the show. So tell us a little bit about Al Correlon and how you got yourself involved in this.
Sure, absolutely. So Al, my business partner, started up the KE Report over 20 years ago. And he started by talking to some of the big name CEOs, more of the mainstream stocks that everybody knows about. He was talking to the Boeing CEO and these type of companies 20, 25 years ago. And what ended up happening is Al saw an opportunity in the resource sector and he switched the focus of the show. Now, this happened before I even came on board, but as I was going through my CA at the time, which is now a CPA in Canada, I met Al on a site visit or a couple site visits where I would go visit the mine sites or exploration sites of different resource companies. And he was there interviewing the CEOs and looking at the projects. I was there as kind of a helping hand to some other investor groups where I would go and just see almost the legitimacy of these type of properties. This is all when, as I said, I was doing my CPA. I was auditing a lot of resource companies, and quite frankly, auditing just isn't all that much fun. So as I went through, going through all these financial statements, I saw kind of the other side of the industry where it's more getting in front of people, and it's all about telling the story, getting the company in front of the right people so that you have support when you build a resource company. I live in Vancouver, so Vancouver really is the hotbed of exploration companies and even some of the largest mining companies in the world. So it was a great opportunity for me to see both sides of the industry. And about, let's say, 5-6 years ago, I moved into the KE Report and helped Al kind of update his message. He very much was talking to a lot of gold-focused people. But then since I've come on, I bring on the likes of you and other guests that I consider more generalist. They look at the markets from a very different light than a lot of resource-focused investors do. And that to me has given me a different perspective on the whole sector, as well as kept me up to date on what's going on around the world, because especially for resources and for a lot of markets, these markets depend on what happens in a lot of different sectors. So there's a lot of correlation that investors do need to pay attention to. And that's what I try to bring on and tell to our audience is the bigger picture of what's going on around the world in financial markets and even major news events that do matter. And we always do kind of circle back around and see where the opportunities are when it comes to investing in resource companies, whether it's small, mid-cap, or large-cap companies. This all just goes hand in hand with producing a show on a daily basis, and it's a 2-hour weekend radio show where we just try to make sense of what's going on in the markets, not get too emotional, and have some investment themes and ideas that people can hopefully utilize to help their portfolio. And really these times, especially right now, Rick, you and I have talked a lot about just how crazy these markets have been and how it's an evolving picture for a lot of sectors, which definitely includes the resource sector.
So, Corey, when you say that this is a cast but also a radio show, tell me, so is this being picked up by stations across the country?
Yes. So across the US, we're in about 25 different markets around the US. It's syndicated through the Genesis network. So our show is recorded usually at the tail end of the week, and the radio stations pick it up and play it Saturday, sometimes replay it Sunday, throughout however it fits into their schedules. So I can always share when it's available, but I always just tell everybody, come to our website, kereport.com. Everything is posted there, or on our podcast, Corlin Economics Report. You can find that there. And that's how you get a full overview of all of the segments that we do on a daily basis and that weekend show.
Wow, that's terrific. So Al seemed to have concentrated on the metals markets, or let's say the natural resource space. And as time has gone on, you said you've evolved this into a more broad audience, both in the sense of people interested beyond the metal space, but also the guests you have. You're saying more generalists. So let me ask you this. Considering you speak to such a wide group of people, what do you feel is the general consensus about the stock market? Because you really have two distinct parties here, a very bifurcated market between very vocal bulls and very vocal bears. And we don't often get such disparity, but I see economists who are saying that we're going to fall apart. It's only a matter of months to a year before the US goes into a full recession. And that's certainly keeping a lot of individual investors out of the market as they hear people talking about that. And yet the market, as I mentioned earlier, we're less than 1% from all-time highs today. So what do you hear on your side from the variety of guests you have? Are they bullish? Are they bearish? Or do you really got a mixture?
Rick, I really have a mixture, and I see the exact same thing that you see. There's a lot of very vocal bears. I find the bears almost more vocal right now than the bulls, but I think that's also a function of almost a 10-year bull market where the bulls don't need to be vocal right now. They've made a lot of money throughout this whole run, and we do still see that bullish mentality of buy the dip. So I'm, as much as I see these markets showing some cracks and the definite time frame for some sort of a rollover and albeit very natural correction, there's still a lot of hands, I think, that you can say on the outside, such as central banks and such as all the money that has just been created over these last 10 years plus, that is still looking at US stocks especially as the safe place to be. And even as you and I have talked, there's been so much news driven or headline driven markets and moves. But when you take a look at the long term charts, and that's one thing I really like to focus on, I always start with a monthly chart and start to drive down into the shorter term charts. That monthly chart, yeah, we had a tough end of the year in 2018, but quite frankly, it was bought back very quickly, and it didn't break a whole lot of uptrends or support lines that made people get even more bearish. So I understand where the bears are coming from, but it's still such a dangerous market to short, because at any day we can get a tweet or we can get some sort of a trade deal, whether it's good or bad, that can drive these markets higher. Plus, we have central banks that are more dovish than they have been in the last couple years. And during those couple of years, yeah, we moved sideways, choppy in US markets, but we still had that uptrend. And if central banks get even more dovish, why should we expect something completely different to happen than what has happened when they did turn dovish after that last financial crisis?
Yeah. Look, in the last few months, and especially over the last few weeks, U.S. investors are believing that the Fed will loosen at some point this year. Now, the Fed starts a meeting today, and we'll find out tomorrow more about what they said. But clearly, the marketplace is pricing in a cut. And the biggest thing here that I think as a macro strategist I have to deal with, and you probably hear from the people you talk to, is the fact that the S&P is, let's just say for practical purposes, on all-time highs, and yet the bond market being bid up as high as it is, and today yields are down at 2.06%. So we're pretty darn close to the low of the move in yield terms. You've got a bond market that's saying recession, and you've got a stock market that keeps moving higher. And that typically doesn't happen. Now, there are periods in historical periods that it does happen that you get it different here, where stocks keep moving up and yields keep moving down. But at this juncture, it's really hard to kind of look at a bond market that is so predicting recession at the same time that stocks are on all-time highs. What says Mr. Fleck about that?
Well, that's why it's such a weird market. But to me, that just means that there is so much liquidity in the system right now, where investors, again, have made so much money during this bull market in US stocks that now they're starting to take some safe plays. And that's also why we've been seeing other assets such as gold move higher. So there is this general switch that's happening right now, I think, where investors are starting to get a little bit more defensive. But again, with central banks now perceived to be even more dovish and all this liquidity still in the system, and still we need to consider that as much as a lot of these bears want to say that the US economy is a bad and slow or shrinking economy, fact of the matter is the economic data coming out of the US, yeah, it's not booming higher, but it's relatively better than everywhere else across the world. So that is just another reason for money to continue to at least stay in the US market, in my eyes, but also continue this general shift into some of these safer sectors, such as bonds, such as gold, and even the US dollar, which has remained relatively strong over the last year and a half now.
So Corey, let's talk about gold, because I know we have lots of listeners that are interested in that market. So we've got a chart up here of gold going back to, let's say, 2007 or so. So we've got a good dozen-year picture, and I've drawn a few lines on here. The orange-colored line is the major uptrend line from the 2008 low, and clearly last summer that line got tested and held, and we bounced well off it. We can see a multi-year kind of rounding bottom that's essentially started as early as 2013. We bottomed in 2015, but gold's clearly been kind of building a base for years. And we've got, I drew 3 downtrend lines from the all-time high, and each one of those has been broken most recently, just a couple of weeks ago, the last one. Versus the early 2019 high. And if you go and kind of look at classic technical analysis, it'll tell you that if you can draw 3 definitive trend lines from the same place and the third line gets broken, usually you've got a real significant move coming. So that would suggest a bullish stance on gold. How do you see things?
I am finally getting more bullish on gold. I take a lot of grief for this on our show because I haven't been overly bullish over the last few years, simply because those trend lines or those resistance lines that you have drawn that are right around 1350, 1370, 1380 that have been in play ever since, let's say, 2014, those have yet to be broken. And this just goes back to talking to all kinds of generalist investors that people like to ride uptrends. And you look at this chart, ever since 2011, gold has been in a downtrend for 3 years and then sideways for 6 years. That's just not an exciting market when we finally see that break above these short-term resistance levels that are so close to where gold is right now. that's when the metal can really start to take off. So I am getting more and more bullish now on a short-term basis. You can also make the argument that gold is overbought right now, so maybe a natural correction. But that support line or that uptrend line that you've drawn that goes the whole way back to 2008, that's also crucial because that washout in the tail end of summer of last year, it was pretty devastating for gold investors, especially those in the stocks, but it didn't break that long-term trend line. So this is very much a constructive chart. However, it's very much a boring chart for those fast money investors, which unfortunately, that's just the way the market and investing has moved because we're seeing very much a U-shaped bottom. If you take that top in 2011 and make this gradual U down through where this metal has traded, well, it's a boring chart. But when we do get that breakout to the upside, then that could very much signify a long-term bull market ahead of us, which again just relates back to all this money that was created that ended up in the financial assets and all this easy money policy, plus these extremely low interest rates. This is a fundamentally good picture for gold, but you always need to go to the charts. And these charts, until we break this, I like to say about 1370 to 1380 level on a weekly and monthly basis, it's still a skeptical trade here. And you know what? If you've traded this market in this range, you've done very well. But if you've tried to play for any breakout, you've unfortunately gotten burned. So again, waiting for that breakout to happen when I believe it will bring a lot more generalists and momentum players into the sector.
I agree with you on this, and I've drawn those horizontal kind of deep maroon colored lines against prior peaks, and that is what people are playing for, both as targets as well as potential breakout. It's funny because I've got, for my institutional clients, we actually have a partial long gold position on at 1295. And this I put out as an investment in gold. Typically we trade for a couple months as a time frame, but this I kind of just have a sense that this time around we will break through those horizontal prior highs in between, let's say, again, 1370, 1380, somewhere around there. And you can see I've drawn some targets here of both 1487 to 1526. 1526 is pretty much where gold broke down from in the early part of 2013. Once it took out that double or even triple bottom there, it never saw it again. And then the one reflex rally, when it had broken down, had gotten as high as 1487. So to me, that kind of becomes the investment target for this. I have no reason to think gold's going to make an all-time high, but I do think, you know, we potentially have a couple $100 on the upside to play for. Now, I don't think you can get there without the dollar getting some weakness, and that will be crucial for the entire picture, is whether or not, you know, the dollar breaks down. It's been trading kind of in a channel, and recently, I think it was 2 weeks ago, it got to the bottom of the channel and has bounced since then. So, you know, dollar terms, I think the dollar index really needs to break kind of under 96 or so to really start putting some pressure on, which will help the metals.
And I agree with you there, Rick. And one other comment to quickly make is that the dollar price, or the USD on the dollar index, has actually been trending higher for this last year and a half. And it's been one of the more constructive gold markets besides that drop in the tail end of summer. So this is one of the first times in a few years that we're actually seeing the dollar in an uptrend, which has been losing momentum while gold is testing this upper boundary. The last time gold was looking really strong was, well, 2016 and the tail end of 2017. 2017 was a horrible year for the dollar, so it gave it some room to bounce. Now the dollar, a lot of people are saying, could easily roll over, which you're right, it could provide that boost to gold.
Yeah, that's what I think most people are playing for, is that the high at the DXY between 98 and 98 and a half or so will pretty much hold, and that, you know, the dollar can get some weakness. And look, I don't get into the crypto space. I will not trade Bitcoin or any of the cryptos. But Bitcoin itself has moved up rather dramatically over the last couple of months. And, there's many people out there saying that Bitcoin will replace gold as the de facto hedge against uncertainty. I don't buy it yet. And I literally don't buy it as an investment. And I just won't play that space. I don't have enough understanding of why it moves and why it's as erratic as it is. And it's the same type of thing. I had discussion over dinner within the last week with some people about gold, and they're saying, gold has no value in and of itself. It's simply what human beings have assigned to it. And that's pretty much true, other than some very minor industrial use and, of course, for jewelry. In and of itself, gold has no intrinsic value except what we place on it. But unlike Bitcoin or any type crypto, gold has been the kind of de facto backer of currencies, even though we're off the gold standard. But there's still this multi-thousand-year belief in gold having value. Bitcoin and cryptos are brand new and not something I'm prepared yet to get into. What are your thoughts on the cryptos, just quickly? And then I want to get to some other metals charts.
So cryptos definitely caught everyone's attention a couple of years ago when it made that run. And you know what? I think cryptos have very much, especially Bitcoin, established itself as another market for people to trade in. And some of the younger generations, they like trading cryptos and Bitcoin. I personally don't think it's taken a whole lot away from the gold sector. These are different investors that, maybe will come into the gold sector, but they weren't paying attention to the gold sector anyway. And a lot of this, I think, just comes down to more of a distraction. We talk on our show a little bit about cryptos just because there is the interest there, but to me, it's a different market altogether. And that also goes with cannabis. Everyone's made the excuse that cannabis is taken out of the gold sector, and especially in terms of stocks. You know what? Maybe, but overall, gold does have the ability to run higher without some of these new markets also breaking down, I think.
Yeah. Let's take a look at gold's much poorer younger brother, silver. Gold is trading somewhere close to 90 times the price of silver, which is historically rather high. And look at how different a chart this is. We go and we draw three trend lines off the 2011 high like we did for gold, but we have a totally, totally different picture. Silver kind of, it's basing for a few years, but cannot get out of its way. But again, recently this year, we kind of came down again and tested that horizontal dashed blue line where we have found other lows for the last 4 or 5 years. And I think even silver can move up here. I think the big question becomes, would it outpace gold or not? So any thoughts on which would be the better investment?
Well, I personally like gold. This silver chart, Rick, you and I have talked about it. It's pretty ugly. Like, this is not exciting at all. But the fact of the matter is, if gold gets moving and there is money that flows into gold, there's naturally going to be money that flows into silver. It's a lot more the retail investors that go into silver. It's typically termed the poor man's gold. And that's because it's so much cheaper. So people feel like they can buy more. And you do get some better returns when they are in a bull market, but you also can lose a lot more money. And I always drive down into the stocks too. And in all fairness, silver stocks have been really, really beat up here. Gold stocks have also been beat up, but at least we're starting to see some of the larger gold names get a buy. And that's even more encouraging. It shows more institutional money, more big money coming into the sector, albeit very slowly. Silver still very much stuck, and it's really hard to get on a bullish trend here for silver outside of the fact for gold breaking out. So that's kind of silver's main bullish argument right now, is that it's lagged gold so much that once gold breaks out, silver's got to play catch up. You know what? That might happen. It does happen in a bull market, but it can take a couple years for silver to start to play catch up. So personally, right now, I like either taking a position in gold or some of the larger, more established, and even profitable gold stocks, and then ride that wave for at least 6 months, maybe a year when that breakout does happen, and then start to diversify into silver. But right now, you're still trying to pick a bottom in silver, which has been a loser's game now for a while.
Yes, it has. Yes, it has. It is a sleeper of a market. I know, a long time ago, I hate to say how many years, but it's more than 20 years ago, I used to trade on the floor of COMEX in New York in the pit. Back in the day when silver was very active. And I can tell you, this puppy can move when it gets going. It's rather deep now, actually surprisingly deep at each bid offer. It's uncharacteristically deep, meaning there's plenty of bids and offer size at each bid and offer. But this thing can become very illiquid quickly because when institutions jump on it and it moves in one direction, it really can move quickly. But yeah, it's been a terrible sleeper. And talk about sleepers, and this is the one that's kind of got me perplexed. Let's finish off today talking about platinum. So unlike gold, which had broken multiple trend lines from the 2011 high, if you look here in 2011, and I'll kind of highlight, so gold made new all-time highs in 2011. Platinum didn't even get close to its 2008 high, which was all the way up here on the left side. And this year, we're getting close to testing last year's low, which was the low of 2008. So, we've got this massive triangular pattern here, but platinum's hanging out at $800 an ounce and just isn't moving. And you think of it as an industrial metal, this certainly has far more usage than does gold from an industrial use. It's part of catalytic converters. So what do you think here about platinum?
Well, again, another pretty ugly chart, but the thing that you just said there, its industrial uses are very much focused on catalytic converters, and we're seeing a general shift in the auto industry here. Plus, the auto industry has been generally weak. We have tariffs that are causing some havoc or uncertainty about the auto industry. All of this hurts platinum. So platinum really does get a boost more so than a lot of other metals, even silver. People make the argument that silver is an industrial metal and look at all the uses. Well, that is true. Fact of the matter is when silver price runs, people find substitutes and, well, it's just not used as much. And then everyone jumps on the precious metals argument. Platinum here, I really think it needs some sort of a rebound in the auto industry or some other use in terms of another sector to drive it higher, because platinum right now, it's a bad chart and it very well could get worse. It doesn't have that same emotional impact that gold does and even silver does to a lot of precious metals bulls. And that's one other thing to consider. Whenever you're looking at any market, but especially precious metals, it's all about emotion. And you just don't have those diehard platinum bulls out there. You have gold bulls, silver
Correct.
bulls, not so much platinum. And that's what's really holding platinum back is people don't care as much about it. And the auto industry, generally, there's a lot of uncertainty out there.
Corey, we've got 20 seconds left. Just tell our listeners how they can hear you again each week.
All right. The easiest way, www.kereport.com. And you can also email me, fleck@kereport.com. I love hearing from all of our listeners, and I make sure to get back to everybody with answers to all their questions.
Corey, thanks so much for being our guest this week. This is great. We will have you back in the future. Reminder, tomorrow I'm speaking in New York City at the AUG, the Exchange Conference at the Princeton Club. Catch me there. And that's it for this week's In the Know Trader. I'm Rick Bensignor. See you again next week.